from between 6.6 all the way up to almost 8%. So Buckeye, Surprise, Peoria, Glendale, all areas that have had a lot of new home construction over the last 5 years, you will see their appreciation rates much higher than other parts of the city. 7, they win out of all the cities. But again, between Queen Creek and Buckeye, both of those areas have had an extremely high level compared to where it was just last year. They had gotten as high as almost 14%, but 8.6% for Paradise Valley, where you've got a median or a price well over $1 million, is extremely positive. And mostly, again, who else has had more new home construction? Paradise Valley. At 100, both of these are green. Notice the green. All of these are green because they're good for sellers. Anything that's good for a seller is good for appreciation. If it's red, it's bad for a seller. That's it. And if it's yellow, it's just normal. So basically, everything in the green right now means that everything is positive for sellers, positive for annual appreciation. And it is at record highs. We know why it's causing some distress, if you will, in terms of anybody who lived through this period and gave bad advice, and I hate to bring up bad memories, and I may have been in there, you never know, is wondering what kind of advice should I give this time around. And so how is this different from the last market, and how can we expect prices to respond? So what happened to our annual appreciation rates? So the other times that we've gone through this, you'll notice here, this was the period of time where it weakened. This was where our appreciation was. So our appreciation did this. So again, we went down here, but our appreciation rates annual stayed high. We went down here, appreciation rates annually stayed high. And of course, I'm using the monthly versus the last month. I'm using the most aggressive one. Take a turn down. We can expect this to continue up and then possibly go down. Does that mean that your prices will go down? No. Because anything above 0, this black line, anything above 0 is still positive for appreciation. So what happens is your property values just rise slower. And I'll use another visual for you, but in a different way. So here we are. This was 2005. We hit 313 on the Cromper Market Index at that time. That was insane. We never thought we'd see that number again. But it took 8 months to get to balance at that level. In 2013, we started once again towards balance. It took 6 months at that level to get to balance. And here in 2010, we were so just barely in a seller's market. It only took us 2 months to get to balance, and then we bounced around on the seller side and then went down to the buyer side and basically stayed in balance for almost a year there. How long, given these examples, how long do you think it will take us to get from 344 on the Cromper Market Index down to balance? And as you can see, we've already leveled off. We have not started down yet, okay? It's really important to understand that. We haven't started today. How long is it gonna take? Is it gonna take 8 months, 6 months? Probably not 2 months. Probably at this level of where we are right now, exactly, Allison, I would say at least 10 months to get to where we are today, down to a balanced state. If we continue down, if everything stays the same for 10 months. So that's when we go back and we look at, well, what did they do last time? In 2005, right here was the turning point where the market peaked and started down. So you'll see the trajectory of price, and then the trajectory just went off slightly. Again, prices still rise, they just rise slower. So again, here we were in 2009, and then we went into balance. We went to the rate of inflation. So we actually rose just barely, but looks pretty much like we went flat, because that's what you do when you go into balance. You don't lose price. Your prices don't decline in balance. They just go to the rate of inflation. And at the time in 2010, the inflation rate was like 0, just about. But in 2011, it was negative. So again, this was the turning point there, and it just went flat. Here was the turning point in 2013. We were going up, and then we just went at a slower rate. So at this point, mind you, we have not shifted. We're still at the top. Haven't even started down yet. But if we were to start down, this trajectory we are on will most likely just do this. So it'll go continually as the Cromford Market Index is coming down. So again, we don't see prices decline unless you go into a buyer's market of supply and demand indexes. So when we look at them together, we kind of get an idea of where they had to be before a crash, before a price crash of the magnitude that we had. So here we were, this was our bubble, this was the peak of 2005, and it's not that far off from where we are today, if you'll notice. I mean, slightly more demand on the percentage side, but we have slightly less supply this go around. For us to get primed for price reductions is our supply line took a turn, and it took a very fast turn. And demand also took a turn, and it took a relatively fast, but not as fast, a turn. But notice how long this took. For us to get from here to get to a place where we were right before the crash. This was 2007. So if I can just remind you real quick where that was right here. 2007, that's where we were. So right before the crash, this is where our supply was, 113% above normal, and this is where our demand was. So that did not take months or weeks to get to. That took 2 years to get to that point. So again, if we are going to have a price crash, we're going to know way far in advance. We're going to have lots of indicators telling us that this is the way we're going. It's not going to be a big surprise to people. And so that's why I'm saying if you have a seller who's convinced that our prices are going to come down in the next few months and they need to sell right now, they're going to be really disappointed. And we're not at the precipice of a crisis, of a price crash to the point where they're going to lose any equity. It just wouldn't happen. Not until this goes up like this and this goes down like this. That's what has to happen, and that's not where we're going right now. For the record. People need a place to live whether or not, whoever wins. And we need a president, okay? That does not affect whether or not we need a house. So that part doesn't really matter. What does affect housing is policy. That helped in the past may not help today. One policy that helped us a lot in the past was the first-time homebuyer credit. When we look at the first-time homebuyer credit, which was passed just literally months after the Obama administration was elected into office, they passed it in February. We needed it then. Look, we had more supply than demand. We were still in a buyer's market, and it threw us into a seller's market literally within a matter of months. And it stopped our price appreciation or price depreciation on a dime. It happened right here. This is it. See, March 2009, it's right here. February of 2009, stopped our prices from dropping right away. If we were to do that, it would only shoot our demand higher, and it would shoot our supply lower. It won't help prices. It doesn't help affordability. If anything, we need more efforts on the supply side. That is out there is Fannie and Freddie, the privatization of Fannie and Freddie. Some of you may disagree with me on this, but I'll tell you this. Whenever Wall Street gets involved in residential housing, they screw it up. What people think, well, when we talk about where's this supply going to come from, the first thing that people think of right away was all these forbearances are going to lead to a foreclosure crisis is the 90-day notices, the notices of trustee sale. Last August, we had 56 of them. So you could literally have probably, 100%, 200, 500% increase. But you can expect, prior to this, we had 388 a month. You're probably going to have, 1, 2, 3, 4, 5 months worth of that because they were just put on the back burner. A little bit of time to sell their home. You've got 90 days. From the time you find out that you're at risk of foreclosure, you have 90 days to sell your home. There are homes selling, and literally, I know somebody who sold a home before they were done pounding the sign in the yard. Literally, that's what happened. Buyers drove up and went, that was it for sale yesterday. And they bought it. A foreclosure crisis at this point, or some kind of massive increase that would not be bought up by the current demand we have. Let's just look at real quick where we were in March of this year compared to January of 1996. Now remember, for those of you who were not here in 1996, but those of you who were will remember, we were much smaller as a metropolitan area in 1996. Pearland wasn't even built yet. And if I remember correctly, I think Scottsdale Road might have turned into one lane in either direction at Greenway. I think there were still dirt roads and horse property on Cactus Road past Pima, and I'm not even sure Pima Freeway went all the way up at this point. So just imagine how much we've grown. And I think I did in 1996, I may have traveled once down to Gilbert, and I think it was one stop sign in all farmland today in March before the pandemic than we did in January of 1996 when we had significantly fewer homes. We were significantly smaller. We had 9. Somebody wrote up there 2 for sale today at the auction. Well, you got 2 out of the 9 that were recorded last month. And see all these blue? The blue means it was sold to a third party at auction and never even went back to the bank and never went into MLS at all. So almost all of them, if they are being auctioned off at all, are being sold to third parties. They're not going into bank owned at all. And again, March before the pandemic, it was 65. In January of 2002, again, we were much smaller in 2002. We were at 387. February of 2006, we only had 25, which I understand how people could say, well, what about that? Well, remember when I was talking about the glut of housing we had? We had over 100,000 brand new homes hit the market in 2006 and 7 when all of the funding pulled out. And then all of those people who got adjustable rate interest mortgage payments, all of a sudden the interest rates went up, and unemployment was at its peak in 2010. All kinds of perfect storm things happened here. We're not really projecting all of that for here, but I can see how some people can say, oh, well, here we were in August and here we were in February of 06 and look what happened there. So that could potentially happen to us now. The thing is, again, population growth versus housing growth. We had more houses than people back then. Now we have more people, a bunch more to expire. So we'll see what happens with that. But so far, every time, these forbearances, when somebody goes into forbearance, it's typically for a 3-month period. So when we saw them happening in April, May, June, at the end of June, we saw a drop off. And then June, July, August, and then we saw a little drop off at the end of August, but we're expecting another drop off in September at the end of this month. But so far, every time we've gotten an update on this particular metric, it has been declining. And if you'll notice, the Fannie and Freddie, which were the number 1 percentage rate, is now declining faster than FHA and VA and other. And just so you know, the other are your jumbo. So jumbo are basically non-conforming loans, which could be investor loans and so on, have remained relatively steady. So look at where our equity was. If you had owned your home for 10 years, in 2010, you were upside down in what you paid for the home. You know, if you were lucky, you didn't have a mortgage on it. But overall, we saw a lot of people who did not, they didn't have any equity. So if you have to go through foreclosure and you want to try to sell your home and you have to come to the table with money, that's not a viable option for a lot of people. And so that was basically a no-brainer for a lot of people who went into distress and decided just to let the property go and shut themselves out of the housing. 2010, you most likely, on average, we have 141% appreciation from 2010. And so who's going to walk away from that kind of equity? If you come into distress, you can just sell your home as a regular sale. Bubble, you went through the crash, you hung on through everything in between. You're up 104%. So again, the long-term view of housing, it's always been a long-term investment, is if you're afraid of prices going down, just don't sell your house. Drawing your eyes to the time of the crash, because it's real important. All these little pieces do fit together. And affordability is also a number 1 thing. So if we ever think about what will slow our market down, what will slow down appreciation, slow down demand, all of that, affordability typically is the number 1 thing. So as we look at our affordability over time, this is the HOI index, measures what percentage of homes were affordable to a family making the median household income, which is 2 people, family income, just $72,300 a year, what percentage of homes were affordable to that family in the second quarter, given today's lending practices and interest rates and so on. And that number was 64.8% for Phoenix. That is normal. Actually went up in the second quarter and not down like the United States did. When the affordability gets below 60, we get a little bit worried. What happens when affordability gets below 60 is that our demand index, which is now 23% above normal, will start to decline. 18 to 12 to 8 to normal to possibly, but over the quarter, we should have the newest one for the third quarter after September ends, of course, and then we will probably get the updated HOI possibly November, late October if we're lucky. But overall, I expect that to be slightly down. I'm not so sure that it's going to be below 60, but I do believe it's going to be down. This is the fourth quarter of 2018. And what we saw in 2018 was on the demand index, and excuse my scrolling, I'm going to scroll up to our demand index, so affordability. Over the course of about, let's see, this right here, that's July of 2018, and this is right about July of 2019. Over the course of a year, our demand index slowly went below normal. We still had more demand than supply, so we still saw prices increase, but because both indexes went below 100, the number of sales declined. A little bit nervous. So what would have affordability below normal, this would start to come down, just like that. Has not happened yet though, so far. Now, what happened during the bubble, which was right here in the first quarter of 2005, we went below normal affordability and kept going regardless of the fact that nobody could actually afford those homes. And they came out with all these funky loans for interest only, no money down, 110% financing, whatever they could to try to make these homes affordable to people who cannot afford it given the typical measures. And that is not the way to go, like I said. Flag. That is not the time to buy. I would never buy when affordability is that far below normal. Now, was it a good time here? Yeah, that's not too bad. If you can afford it, if you're one of the few people, the minority, if you will, the 50% that can afford those homes, then yeah, do it. But this isn't so bad. But when it's doing this, that's not good. That's not good. But you always want to be buying when it's affordable for the majority of people. And of course, that's the interest rates. And of course, we had our little COVID interest rate of 3.65%, where the lenders were just screaming mercy. But since then, they've come down, almost a full point from January of 2020. So at 2.86%, this is what that means for our payments. So we're now going to do the rent versus buy. And this is going to, again, there are some correlations I want to make here to decisions sellers made during the bubble and crash and decisions sellers would potentially make now. So at this point, we're looking at a payment, a principal and interest payment of $1,338. This actually went down $2 from just a couple of weeks ago, frankly. Even as our price went up about $2,000 for a 1,500 to 2,000 square foot home, and I am using an average, but once again, we're using like for like. These are only homes within 1,500 to 2,000 square feet. And so we saw an average increase in those prices of almost $40,000, but your payment has stayed within about $35 of $1,305 to $1,340. So nice stable payment for almost a year now, with these interest rates considerably coming down. You'll notice that over time, we've seen this many times before. We went up $20,000 here, stayed for 15 months right around $1,000 to $1,039, went up another $19,000 here, stayed nice and stable for another 13 months at $1,146, $1,186, and now here we are at $1,305 to $1,340. When you add in down payment, $36,000, that does go up, plus all of your taxes, insurance, PMI, all of that, you're looking at an estimated total payment of about $1,703. Now, and this is the big key, okay? So rent for the same size home through MLS is $1,795 a month. The same 1,500, 2,000 square foot home. One thing I want to point out here that's really, really important is look at what rents were doing between 2001 to 2005. Rents were $1,000 a month in 2005. During the bubble, you do not see rents decline when housing values are rising 45% a year. You don't see all of this demand for housing and see rentals decline. Does that make sense? The only reason a rental rate would decline is a vacancy. There's no one to live in the house. And it's not because they were all buying new homes. It's because we didn't have the population growth. See, the thing is, as homes became less and less affordable, you would expect people to be running to rentals, but there was nobody there. And so now you've got somebody, the peak of 2006, okay, here we are, we're heading into a peak of price. We've got all of this supply available for people. But what happened was the people who had bought in the peak of the market and their interest rates went up and they had an adjustable rate payment, right? Their payments went up to like $1,800 a month for a 1,500 to 2,000 square foot home. That's what they went up to, 6.5%. And their payments went up beyond their affordability, and rents were $1,000 a month. That's a no-brainer for somebody to leave the home that they didn't put one dime into and just go rent. We have are people who have purchased their home within, let's say the last 5 years. Just let me get rid of my annotation here. 5 years ago, if they've owned their home for 5 years, they're looking at a payment of, let's say $1,200 a month, maybe $1,300 total payment, because they've owned their home for 5 years. Not to mention they've got 5 years worth of equity built up in it, right? So if you've got somebody whose mortgage payment is less than rent for the same home, it doesn't make any sense for somebody to allow their home to go to foreclosure. So again, even if they're in forbearance, they have all of these options. They can get a roommate because they didn't really put in very many during the pandemic, and so they probably saved them up and then they put them all in at once. So I'm not sure that we're going to stay at that level, but that is good news for your buyers. We should see some more supply coming on in the next year. All right, demand. You would expect to see in a year is January is the lowest. We peak in May and then we come down. Every year this happens. Every year, except for 2020, because this is the year of opposites. When we're supposed to be up, we're down, and when we're supposed to be down, we're up. That's how it works. So I don't know how else to explain how off-season this is, except for showing every year since then. This is our season every single time. August. You notice this plus 9% right there? Right around August, we saw a 9% increase. We went up when we were supposed to go down, and we haven't really gone back down. We are actually going up again when we're supposed to be going down. Why is this? So one of the things that there's a lot of different theories on it. One of the theories is that, school didn't start. Typically in the month of August, people say, well, my kids are starting school. I don't really want to disrupt them. And then, then they get them all into school and then the holidays and then blah, blah, blah. We'll outperform September and October for closings compared to last year. So those will be all of your headlines later on. And we were expecting, we kind of expected this. This wasn't a big, we got that. And then we had our surge and we were expecting it to kind of go down. You can see normally, this is what we would see. A peak in May, and then it kind of goes flat. We typically don't see anything exciting in the latter half of the year, except for 2020, the year of opposites. So we are now accelerating in our sales over 600,000. And that is bringing us to dig in as analysts even further, like what is causing this luxury market to go crazy? So the first thing we look at is Wall Street, because Wall Street not only kind of dictates things like, our retirement communities that may be reliant on their portfolios performing. It also deals with jumbo financing, which is a big deal. So as we already experienced when Wall Street crashed, our jumbo financing went away like almost overnight, and then it came back. So obviously the stock market's been performing quite amazingly over the last 6 months, but in September it kind of dropped off.
And there's always a little bit of fear that, from what I'm hearing and seeing in headlines, there's that fear that they could see another crash. But so far, that's not come to fruition. And at this point, there's nothing telling us here why we're seeing such a major influx for Phoenix specifically. And it's certainly not showing us anything on corporate profits. When we look at corporate profits over the first half of 2020, typically for luxury, they like to see their corporate profits doing well. They like to see stock market doing well, see exchange rates doing well. All of that will fuel your million plus market, or even your 600 and plus. But this last report, we saw corporate profits at one of the lowest points they've seen in a decade. So that's not fueling demand for us, for luxury. Something else is fueling luxury demand.